Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for the second day of the Precious Metals and Critical Minerals Conference. Our next presentation is from Ecora Resources. Please note you may submit questions for the presenter in the box to the left of the slides, and you can view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Jeff Callow. He's the head of investor relations for Ecora Resources, which trades on the OTCQX Best Market under the symbol ECRAF and on the TSX and the LSE under the symbol ECOR. Welcome back, Jeff.
Thank you, John, and everyone involved. Thank you for having me here today. And thank you for joining, most importantly. Very pleased to have this opportunity to take those of you that aren't familiar with Ecora Resources through our story and give a brief refresher for those who've heard the story before. As John said, my name is Jeff Callow. I'm the head of investor relations at Ecora, and I'd really like you to think of two key themes to take away from today's presentation, if and above everything else. The first of those is we are a royalty and streaming business. But like many royalty and streaming businesses that focus on the precious metal space, we're effectively taking that business model but applying it to the critical mineral space. So copper is our biggest exposure, followed by cobalt and nickel, rare earths and other commodities. And that puts us in a slightly different position to some of those other royalty companies that you see out there. The second thing is I'd like you to come away with a feeling of our growth trajectory. If we look out over the next 5 years, we expect to see our revenue more than double and growing to over $100 million on analyst forecasts. And free cash flow as well is expected to grow 270% from the start of 2025 through to 2030, commensurate with that growth in revenue. So we're seeing ourselves as a very fast-growing business, applying a very proven business model to a commodity basket, critical minerals, that is definitely one that's aligned with a lot of the trends that we see in the world today. And we think there's obviously shortages of some of these commodities going forwards. With that, I've covered a few points on this slide. Maybe I'll just draw your attention to the fact that, we do have very high quality operations at Ecora. We're very focused on the quality of our portfolio. We're making these investments for 20 plus years. So the quality of the mines that we invest in is imperative because we can't dip in and dip out as equity investors can. And if we look at the quality of our operators, you'll see as we go through the presentation, they're the likes of Vale, the likes of NextGen, the likes of Capstone Copper, BHP. There's some real top names out there in the mining space. So the risk that you're taking investing in a company like Ecora, which has an enterprise value of around $400 million, is not the same sort of risk you'd be taking if investing in a mining company, which probably has one or two assets of a similar market cap. We're giving you actually access to a diversified portfolio of assets operated by really high quality blue chip mining companies with huge market caps if you add them all together. I say we are income generating, about $55 million expected this year on the analyst consensus numbers, and we pay a small dividend of around 2.81 cents per share last year. So we're a reasonably well established business, and I say we're going through a transition at the moment away from coal towards this critical minerals focus, and that's what's going to drive the growth going forwards. A snapshot of our portfolio here. You can see, as I say, if you looked at this maybe 10 years ago, the top left there, copper, is now 50% of our NAV. If you looked at that 10 years ago, we would have been 90% coal. And that's important backdrop and context for this presentation. We were effectively a single asset business with one very high quality metallurgical coal royalty in Australia. And that effectively rolls off in the next 2 years. And so the business has been focused for the last 10 years on ways to replace the coal income and with these critical minerals royalties that will drive future growth and actually be the future of the business for the next 20 to 30 years. And what you can see on the top left here is how we have transitioned that portfolio successfully. Coal would now be in the bulks and other category, which is less than 7%. So the coal is very small now in terms of the NAV. Base metals is the vast majority of that at 82%, and copper sits at the heart of that with 50% of our NAV now weighted towards copper. And we're really pleased. We think that's the right positioning for the world and the trends that we'll see going forwards in the world today, be it robotics, be it data centers, be it AI. be it urbanization, energy transition, all those things lever themselves towards our commodity basket. When we look at that exposure, beneath that as well, we have copper, we also have cobalt, nickel, and rare earths and uranium. So with that, I think it's a very high quality commodity basket. The other thing that's really important when you think about Ecora is we've built up this NAV here now in these commodities. And what we're really trying to see as we go through this transition away from coal is the next few years, we're effectively going to be seeing that NAV unlock and unwind into cash flow. And 2025, sorry, has been a really key year for Ecora in that it's the first year where the coal will be less than 50% of the income as this NAV starts to get unlocked into cash flow. And I'll show you that as we go through the presentation. A couple of other points on this one. Cost curve positioning is a really key point for a royalty company. You want your assets to be positioned low on the cost curve so that as you go through commodity cycles, they stay in production and you continue to generate your income. And equally, if it's a development project and it's low on the cost curve, it should be one of the first to attract capital and one of the first to move forwards in production. Geographically, we don't take a huge amount of risk. OECD plus Brazil, very well-established mining jurisdictions, make up nearly 90% of the portfolio. Zambia is the other 10%, and that's a very well-established copper-producing region, and it's a copper stream that we have exposure to there. And stage of development on the bottom right. If we'd looked at this slide, again, 10 years ago, it would have been nearly all producing. So we think now the portfolio is much better balanced between the assets that are producing today, those that will produce in the next 5 years, and those that will produce into the next decade. They'll come on into production, sorry, in the next decade. And I talked already about our operating partners, but you can see them across the bottom there. Our portfolio in its entirety is shown on this slide here. I won't go through all of it, but 9 producing assets. So quite good diversity there in terms of our cash generative assets for a company of our size. The 2 or 3 at the top there are driving the very short-term growth because they have expansion over the next 2 to 3 years. I'll talk about that on the next few slides, or show that on the next few slides. Voisey's Bay, number 1, is a cobalt stream from Vale's nickel mine in Voisey's Bay in Canada. The mine here is ramping up. It's transitioned from an open pit to an underground mine, and that transition has really started to ramp up during the course of 2025, where we've upgraded the volume of the guidance for the volume of cobalt we will receive delivery of twice this year already, and we're looking at further ramp up next year as well and into 2027. And of course, cobalt at the moment has some real tailwinds from a pricing perspective. Without getting into the details of the policy, the Democratic Republic of Congo's government, where most of the cobalt in the world is produced, have put in place export bans and export quotas, which have effectively driven the price up from $13 a pound at the start of the year to $25 a pound today. So we're seeing expansion of volume and price tailwinds there, which has really driven and underpinned some revenue growth for us. Mantos Blancos, number 2, is a long-established copper mine in Chile, operated by Capstone Copper. There's some near-term expansion potential at that mine, which they'll be publishing a study on in 2026. So we're looking forward to see the potential expansion there. We've also seen volume growth, and we've had 3 record quarters this year of income from, or revenue from, Mantos Blancos as a result of them completing a debottlenecking project very successfully towards the end of last year. So that's performed very well for us this year. And Mimbula is a new acquisition for us. We spent $50 million on this copper stream in February. It's a brownfield expansion project. It's in Zambia, as I referred to a moment ago. A private company called Moxico Resources are the operator there, and very well established, very well regarded management team. And we are seeing that brownfield expansion take that mine from 14,000 tonnes per annum last year. It's expected to expand to 56,000 tonnes per annum over the next couple of years. So further growth for us there. And the copper price has also moved significantly since we did that transaction. The next wave of growth out to the end of the decade will be driven principally by Santo Domingo, a Capstone development in Chile, which they recently brought in a strategic partner, Orion Resource Funds, for 25% of that project, and they're looking to move that to an FID in the second half of next year. At current spot prices, that royalty is worth around $30 million per annum to us. So a really significant royalty for us, and we'll watch that progress next year very closely. West Musgrave is a project, BHP nickel copper. It's been suspended
as BHP suspended all of its nickel copper operations. It's actually part built, it's 25% constructed, and BHP is running a sales process at the moment, or looking to potentially run a sales process to sell and divest of West Musgrave. So that could be very interesting for us if during the first half of next year that changes hands, because you could find a buyer who's very motivated to move that one forwards. And that's, again, $15 to $20 million a year for 20-25 years. So real high quality royalty. And we think that's a matter of when, not if, it comes into production. I won't go through all the others. The rare earths one is perhaps the one to look at. Number 6, Palabora. That's in South Africa. Rare earths, very topical. This is not actually mining. It's taking existing stacks from a previous mining operation, and it's processing them to extract the rare earth elements out of them and turn them into rare earth product. So it's very low cost as a result and very quick to market. So Rainbow Rare Earths have been making a number of announcements recently on that. If you're interested in finding out more, I would urge you to go and look at their recent public pronouncements. Well, that project is moving forwards very, very well, and we look to see a DFS on that probably during the course of next year. And longer dated, but still very exciting from our perspective, is number 2 on the blue, which is Patterson Corridor East. If you follow NextGen, we don't have a royalty on Arrow, but they've been drilling up next door to Arrow in an area called Patterson Corridor East and had some exceptional results this year. And we actually have a royalty over Patterson Corridor East. So that's longer dated, but shows that the growth carries on beyond this decade. And talking of the growth, you can see it coming through here. Going back to 2020, the blue is the base metals, the yellow is the specialty metals and uranium, and the grey dashed box is the coal. So 2020, we were doing about 90% of our revenue was coming from the coal, and we were less than $10 million in terms of the base metals and specialty metals. And if you were to take away those grey boxes, you would see a trend of very high growth, very fast growth critical minerals royalty company. And effectively, those coal cash flows have been seed financing for this assets that we're bringing in to replace the coal and actually build the future of the business. So we've been taking these cash flows over the last 10 years, redeploying them, as I said before, into this basket of commodities, which will drive 20 to 30 years probably of cash flow, as you'd expect from a royalty model. 25 is a key year. Coal, as I said earlier, is going to become the less than 50% for the first time. As we roll forward to 2026, you can see the growth in the blue and the yellow. That's coming from these projects, Voisey's Bay expansion, Mimbula expansion that I talked about. And then out into 2030, a little bit more expansion from those current producing ones. And then projects like Palabora, Santo Domingo, West Musgrave coming through, which absolutely transform this business, not just at the revenue line, but also in the free cash flows. It's expected to grow 270% from 2025 through to 2030. So we'll be in a very different position as a business by 2030. And there's no more capital for us to deploy into delivering this profile you see here. We've spent all the money we need to acquire those royalties. It's now waiting for the mining companies to bring those extra projects on stream. I won't dwell on this slide too much, but suffice to say that trend I said earlier of growth during the first part of the year in base metals. The top part there, you can see our Q3 numbers that we published, 9.9 million from the base metals compared to 5.3 in Q2. So nearly 90% growth quarter on quarter, Q3 on Q2 there. And if you look at 9 months 2025 versus the first 9 months of 2024, it's 150% up. And that's really the benefit, as we see, of Voisey's Bay ramping up and the new Mimbula copper stream that we acquired earlier this year, driving those numbers. And we expect both those assets, as I said, to show further growth into next year. We look at how we're valued. This line actually says we've gone up a little bit since I put this together. I think we're trading about $1.40 today on the OTCQX. If you look at this, it's quite unusual for a royalty company that we're trading at. If you back off the net debt, we're trading at a slight premium to value our producing assets. But most royalty companies would trade at much nearer to the value of their development assets as well. When we look at the quality of our development projects, things like Santo Domingo, Palabora, these are high quality projects which we have a high degree of confidence in coming through. So I think the question is really not what do you think could go wrong in those development projects from an Ecora perspective. It's really which one of those, if any, do you think can come through? And if you can, they could all be transformative for us, unlock a lot of that risk value that you see in the yellow there. And that's without some of these projects I talked about below on the box there on the bottom right. Mantos Blancos Phase 2, which is some work that Capstone are looking to do next year with this study I talked about, which could increase the production volumes there by around 40%, all covered by the royalty. Patterson Corridor East is early stage, so that's not included in those numbers either yet. So there's some pretty significant projects for us that don't sit in these numbers at all. We've got a lot of near-term catalysts. Voisey's Bay and Mimbula ramp up and expansion, as we talked about already, and the Mantos Blancos Phase 2 study. All of those will start to see more progress on through the course of the next 6 to 12 months. The Santo Domingo strategic partner has now been solved, so we're looking for that project now to move forwards during the first half of next year towards an FID decision in the second half. Palabora DFS is expected next year. Patterson Corridor East exploration program is ongoing. Nifty is a restart of a small copper mine in Australia, and that project is about looking to restart imminently. Actually, that's the precursor to a potentially more interesting and bigger production underground, which could come through in a few years' time. And if that kicks in, then it would be actually a very interesting royalty for Ecora going forwards. And longer term, you've really just got the next phases of those development projects coming through. But suffice to say, they're really the milestones to unlock that growth that I showed you a couple of slides ago. I won't dwell on this side. I think everybody probably knows that governments are much more focused on securing access to critical minerals at the moment than they ever have been. We've seen it both in the UK. Europe's been a bit late to the party, but European Union is now looking to start building stockpiles. And clearly the US government have been very open about the need to build up stockpiles in critical minerals, be it cobalt, be it rare earths, and they're being very aggressive in the marketplace. So we think there's a very interesting dynamic creating some tailwinds behind our commodities at the moment. I mentioned at the start that we are slightly different, playing a different commodity basket. And if you look on the right-hand side here in the green, you can see all the precious metal. This is just the listed companies playing the precious metal space. And compare that, there's obviously a number of them there. If you compare that to the top left, which is the number of people playing the diversified critical minerals focus. Us, Altius and Deterra. Deterra is very much an iron ore focused business at the moment. We've also got the lithium through the Thacker Pass project in America. But I think we offer quite a lot of diversity compared to those companies. But there's not a huge number of businesses competing with us. So whereas on the right-hand side, those companies are generally transacting in auctions, we generally transact on a bilateral basis and have not had to participate in auctions or competitive processes to date to secure the royalties that we look to secure. We think we've got a good track record of capital allocation. This here shows all the transactions we've done since the current management team came together just over 10 years ago and has been looking to replace that Kestrel income. And what we're showing effectively is the acquisition price, income generated to date if it's a producing royalty, and the current analyst consensus NAV, and then dividing one by the other. The worst performing asset on this basis is Voisey's Bay, which would have washed its face. That's now starting to, as I say, ramp up in terms of production, and the price is recovering. So I think we'll see that one very quickly get well above 100%. To give you a feel for that, we're currently getting $25 a pound for our cobalt, and the analysts are running around $18, $19 a pound on their forecasts. So we should see some upside to that number, I say, going forwards. But I think you can see the longer we own these projects and they go through commodity price cycles, we're able to generate a lot of upside and deliver good returns for our investors, hopefully. The balance sheet, we have a $180 million facility with our revolving credit facility with the top Canadian banks, Scotia, RBC and CIBC. We did actually lever up to do the Mimbula transaction earlier this year. So we took the debt up to about $126, $127 million at that point. We've since aggressively delevered, and the only way we do lever up is if we can see an opportunity to delever with cash flows very quickly thereafter. And in fact, at the end of November, once the royalty receivables due, we get paid for the Q3 royalty numbers in a month later. So once those had flushed through, by the end of October, we were effectively down to about $87 million, which was roughly where we started the year, having done a $50 million transaction. So we were really pleased with that speed of deleveraging. And if we look at the bottom right here, you can see some more forecasts to where we could be at various commodity prices. But we see ourselves deleveraging very quickly into the next 12 to 18 months. A clean capital structure is all I'll say on this slide. There's no warrants or anything like that out there. South 32, the mining company, is our big shareholder. Other big shareholders are Aberforth, Scottish institution, and Schroders. Both have been big buyers this year, and long-standing shareholders. And other buyers there, including some UK funds, some European funds, and some more international funds. We have analyst coverage out of London from Berenberg, Canaccord, Peel Hunt, and RBC, and from North America, from Toronto-based Scotiabank, Orist. And the directors have been buying a lot of stock. They're not the founding management team, so all the shares they hold have been bought in the open market, and you can see the buying there since January 2023. Mark, our chief exec, picked up just under 800,000 shares, and Kevin, the CFO, just under 200,000 shares, and they've both been in the market relatively recently, a couple of weeks ago, buying stock. So I think we're a fast-growing business, good commodity focus, well-proven business model. The portfolio is very high quality, some tier one operators, good cost curve positioning. So we've got that growth profile, and we think we have a very balanced approach to sort of capital allocation. So with that, I will switch over. I can see a number of questions coming in. So if you bear with me, I'll just switch over to those and take those questions. Yeah, good. First of all, question on Voisey's Bay. What's the updated view on steady state cobalt volumes and mine life extension? How sensitive is the stream's NPV to cobalt price volatility? Well, yeah, it is sensitive to cobalt prices. Clearly, we pretty much get not a direct a linear correlation, but it's very closely correlated to the cobalt prices, and you'll be able to see that if you look at our Q1 portfolio contribution from Voisey's Bay, where we were averaging, say, $13 a pound, compared to the portfolio contribution we returned later in the year, when I think Q3 it was about $18, $19 a pound, and Q4 should be pushing up into the 20s. So you'll be able to see that and sort of take a view if you look back at that as to how the NPV is. In terms of the volumes, yeah, look, we expect it to be around 560 tons net to Ecora on steady state. Got to give you a feel for where that is. This year we're expecting 434 to 448, I think it is, tons. So those volumes next year at 560 are a big step forward, and actually there's potential for Voisey's to be run above that capacity, and that's one of the things Vale will be looking at in the coming years, we believe, is if they can take that up and run that beyond the current expected nameplate capacity. Mine life extension, yeah, well, look, we've been to site every year for the last few years, and we think there's a lot of scope there to extend the life of the mine beyond the current mine life, which I think is about 15 or 20 years. We have to wait for Vale to come and update on that. Clearly, it's a relatively small part of their portfolio, but we definitely feel confident there'll be mine life extensions there, and it's got a way to go beyond the current expected mine life. So it's really now performing well, and we're very, very pleased with the performance of Voisey's Bay at the moment. What is the value of our West Musgrave position, and is it income producing? Well, look, I don't. Let me just bear with me a second. I'll tell you what the analysts are carrying it at the moment, because I can't give that out for myself. So currently, the analysts are valuing West Musgrave on a sort of some of them have it on a risk basis, others don't, at about $83 million. It's not income producing today. We acquired that royalty when it was pre-FID, and the project was owned by a company called Oz Minerals. Oz was then acquired by BHP after the project had been FID'd and gone into construction, and folded into BHP's nickel Western Australia nickel unit. With nickel prices falling down to sort of cyclical lows, the decision was taken by BHP to suspend construction activities at the start of that. Decision was taken towards the start of last year, with a view to reviewing it in 2027. So that was disappointing, with a mine which sits at the very low point of the cost curve, was 25% constructed, and sitting in a very good jurisdiction like Australia. What we've seen since, as I say, is BHP say they'll be looking to potentially divest of those assets, and they could do them on an individual basis. So there's a lot of speculation in the Australian press about who the buyers might be, but from what you read in the press, they certainly seem to suggest there's a lot of interest in West Musgrave. So hopefully we can get positive news on that next year, that there's a buyer who's looking to move that project forward, because it is 50% copper and 50% nickel broadly at these commodity prices, and all the upside is copper. So it's an interesting one, and we believe it's a question of when, not if, that project comes into production. Next one, why do you think you trade at a discount and the catalyst for a re-rating? Yeah, it's a good question. I think we trade at a discount because partly we're going through this transition. We were a coal business that had income that was potentially rolling off by the middle part of this decade. So next year is the last sort of meaningful year of the coal income, and it drops to about 20% of income next year, and it'll be well below that in 2027. And I think there was, with Voisey's Bay being delayed slightly, it's about 18 months probably behind schedule, really ramping up in that underground. And with West Musgrave being put on care and maintenance, suspended, construction being suspended, I think there were concerns that as the coal rolled off, how would we replace that income? And I think what we've really seen during the course of the last 6 months of this year, when the shares have started to re-rate somewhat, is that as we've printed the cash flows and people can see that Voisey's is ramping up, people can see that now we've acquired the Mimbula stream, so we've got an additional income stream there which should be expanding. So I think people are getting much more confidence now, and as we continue to demonstrate the cash flows coming through and the growth in cash flows from that part of the business, I think we're seeing much more confidence in the future, and that discount's certainly starting to narrow. And if you look at catalysts, I think some of them were hopefully in those slides. I think we've got some big ones next year in terms of both the continued expansion of volumes from our current producing assets, and equally, let's say Mantos Phase 2, West Musgrave potentially being sold, the Santo Domingo FID, Palabora DFS, lots of milestones in that development projects. Are you funding new royalty streams with debt? How much borrowing capacity do you currently have? Well, to date, with the shares being trading at a discount to NAV, then clearly we haven't been able to use the equity as a source of acquisition currency, which is what, if you look at the model from the precious metals royalty companies, they tend to trade at a premium to NAV. So they tend to use their equity to fund some of the bigger deals that they do. We're fortunate compared to a lot of our competitors in the critical mineral space by having a diversified production base. We have quite a good borrowing base, and I think we've been able to use that to do acquisitions to date, absolutely. But that's what we tend to use the debt for. We see it as an acquisition facility. We don't believe royalty companies should carry debt in the long term, so we tend to lever up to do a transaction, and then we'll try and deleverage very quickly thereafter. At the moment, the facility is about $180 million in total, and we are, I'd say, about 86 million, I think was the last number we put out there. So we've got about $100 million just shy of in headroom as we sit here today. And a final question, I think, what do you think are the biggest misunderstandings about Ecora, and how are we addressing them? I think partly the biggest if you like, a misunderstanding has been that we have income that's perhaps falling off a bit of a cliff in the next couple of years. And I think that the growth from Voisey's Bay and the growth from Mimbula acquisition have started to give people a lot more confidence that actually we don't have a sort of an income hole in 26, 27. We can actually see consistent growth potentially. And this is not just like-for-like growth. This is taking short-dated coal cash flows, which attract a lower multiple, and replacing them with long-dated critical minerals cash flows, which should be 20 years plus, and therefore we think should get a higher multiple over time. So I think as we're going through this transition, there's plenty of room for misunderstanding when companies go through transitions. And I think as we're now starting to, as I say, print the results of that from the cash flows, people are getting more comfort around those, and you can see the share price has responded to that, particularly in the last few weeks. And hopefully that will continue next year as we continue to see the portfolio perform and deliver. I think with that, we're just about at time. So if there's no further questions, I'll say thank you very much for your time and your interest in Ecora. We're very passionate about our business going forwards. And if you have any further questions, please don't hesitate to contact me. You can reach me at ir@ecora-resources.com. Thank you.